How does the market tend to react to inflation numbers generally? Because the Bitcoin market, the first couple of high prints, there was like an immediate spike in price and it dropped back down to where it was. So it didn't really make a difference. Do people just not trust anymore, therefore it has no impact? Are they really always looking at the rate hikes?
Well, the reason why you want to look at CPI very closely is because that's what the Fed looks at. The Fed doesn't care about real inflation. The Fed cares about CPI, which is the official government number.
Okay.
And a lot of people are under the belief that if CPI, the clip at which we're growing, let's say it drops down to 7.5%, that the Fed might say, "Oh, we've tackled inflation. Time to, cut off, tightening." I really believe what's going to happen is they'll continue to raise rates in June and July, despite what the CPI numbers are, and then sometime in August, September, decide, "Oh, we've conquered inflation. We've done everything, right in front of midterm elections, which is very convenient." But I think that's about the time that they're gonna say we conquered inflation.
There's a couple of things I want to talk about with that, because I spoke to Preston Pish the other day. He was here, and he has a similar feeling, but he thinks the next print, sorry, the next money print. He said he thinks they're going to print 5 to 10 trillion. He thinks they're going to absolutely blow any previous injection into the market. They can absolutely blow it out of the water. And that just seems insane to me. It's kind of like you get something under control, then you go absolutely bananas.
I think he could be right. And here's the reason. It all has to do with war.
Okay.
Right? I mean, you got to fund a war. And without fighting directly into it. And by the way, if you look at the latest bill that was passed, that was supposedly the Ukraine aid bill, very little of that actually went to Ukraine. It's just a bunch of other projects, like the art museums we were talking about earlier. I mean, there's all kinds of things that are included in these bills to placate the people that are signing off on it.
Right.
And it's a massive problem in the U.S.
But if they're going to print another 5 to 10 trillion, they're essentially, at 10 trillion, they're doubling the size of the balance sheet in one hit.
Yeah, I don't think it'll be in one hit.
Okay.
But I do think it'll be over a period of time.
And that will be positive for markets, you think?
Yeah. Well, because think about it, if you have more money to spend on things, the dollar goes down, asset prices go up.
But then what?
Weimar Republic.
Yeah, this is what it is. This is yo-yo. This is the yo-yo.
Yeah. This is Zimbabwe. This is Weimar Republic. This is Argentina.
But is it like, okay, like I have this expectation of high inflation, but I can't, 5, 10, real world 20%, but when you've heard of like 50, 100 or runaway hyperinflation, could you honestly see in a scenario where the US goes into hyperinflation? And what the fuck do you do in that scenario?
Well,
you don't want cash.
No, you don't want cash. But it all depends on what the Fed is doing also, right? So right now we're in a really unique situation that's different than 2008. In 2008, you had asset prices going down. At the same time, you had the Fed, the Fed was coming off of a cycle, right? Right now, we have a really interesting situation where inflation is so high, the Fed has no choice but to raise rates, but the economy has gone down. I mean, if you look around and you say, okay, NASDAQ is down 30% right now. In most environments, that would be a really scary thing, but people are just sort of twiddling their thumbs, saying, "Oh, well, it's down 30%. Most big tech companies are down 70%. Okay." It's like, it's not that big of a deal. People don't care as much. Why? Because there's still a lot of liquidity floating around in the system. People haven't been impacted the way that they should have been impacted yet, but it's coming, right? But this is kind of a perfect storm of inflation and markets dropping. Eventually, that's going to hit consumer sentiment, and consumer sentiment's already starting to be hit, right? People are going to start spending less money, and when people start spending less money and start saving more, but they can't save more because their daily goods cost so much they can't afford to save, then you've got a real problem. This is going to look a lot different than 2008, 2009. This is probably a multi-year recession.
Right. Okay. Recession will be tough. You find a way of grinding through it, but genuine 40, 50, 60% inflation numbers, if they can come to places like the US and the UK, and I know Turkey's experiencing it right now. Right. There's civil unrest there, and Lebanon's experienced, there's been civil unrest there. I can't myself picture, and I think everyone listening will be like, well, what does that mean for me? Well, like, what does that mean in reality? And have you done the mental model of what it means for you in reality in terms of, you know, how the economy functions? Like, I just don't know what to expect. Like, I read what happened in the Weimar Republic. I've read When Money Dies, but I still can't picture living through a scenario like that.
I'll lay out a scenario. Let's say that you're 65 years old, which you're not, clearly.
Okay.
You know,
No.
we're way more vibrant than that. But let's imagine that you're 65 years old and you had been working your entire life. You've been saving your money. You've been putting it in your IRA because that's what you were supposed to do. You've got a few $1,000,000 saved up, which by the way isn't most Americans. You know, the ones that are lucky have like $2 to $3 million saved up. A lot don't, and that's enough. You know, 5 years ago, that was enough to hold in fixed income and to earn enough to live out the rest of your life off of your savings. Okay. Most Americans are probably closer to $1 million if they're lucky, right? Just working class people. And let's say that you had planned on retiring at 65. You worked a really hard job. You're done. 65 years old. I've got $1 million. I'm going to retire. Well, what took $1 million 5 years ago in savings to retire all the way through the end of your life now takes $8 million.
Huh. Okay.
So that's factoring in both inflation, current inflation, not potential future inflation, and where interest rates have gone. So interest rates are much lower than they were, even though they've been going back up, and inflation's higher. So literally nobody has $8 million. I mean, you know, maybe the top 1% of Americans have $8 million in savings, but nobody does. So if you were planning on retiring this year, you probably got to work another 5 years.
Right. That's people retiring. But say a scenario, you're a 43-year-old from Bedford.
Mm-hmm.
You own your house, but you've still got 20 years left on your mortgage maybe, and you've got some savings. You know, you've got a business with a good income stream. You're thinking, well, if this is like if we're going to go through like a tough 5 to 10 years, which could be, I mean, Lynn Alden thinks the inflation is going to be the story of the next decade. How do you ensure, like, right, for one, how do you ensure that you come out of that still owning what you have, like maybe a house, and you can still pay your bills, your basics, and then secondly, how do you maybe come out of that having protected some of your savings? Because if you hold it in cash, that's going to get eviscerated. And so what are the options? I know some people will buy vintage cars or property or artwork, but is that literally the only option?
At the moment, that really is your only option. I mean, if you own a house right now, you've locked it in at a good price. Real estate will probably continue to go up. It may flatten for a little bit just because it's become a little bit more unaffordable, but real estate will continue to go up because what's happening is some of the bigger, larger, the larger money managers out there, they have funds that go out and buy single family homes and just hold them. Right. Because they're not earning the income off of bonds. Bonds have gone down in price since October, close to about 6% in price. That means that, you've lost more in principal than what you've gained in interest. So they have these entire funds, like BlackRock, for instance. Entire funds, all they do is just go out and buy single family homes.
BlackRock owns tens of thousands of homes, right?
Probably more than that.
I mean, I remember during the last crisis, they were involved in the purchase of house. Somehow they were linked in with One West. I can't remember the detail.
Yeah, I don't remember either.
Yeah.
But I remember reviewing decks, and this is when I was a bigger money manager back in, right after the crisis. Everybody saying, hey, this is the next hot thing. The U.S. government's printing a lot of money. Asset prices should go up. Housing is at all-time low. We're launching these funds where we go out and buy single-family homes and just hold them. Sometimes we rent them out, sometimes not. Doesn't matter.
It's a store of value.
It's a store of value. And that's what a lot of people have been doing. A lot of big fund companies have been doing. And they're going to continue to do that. So even if you or I can't afford a home, or people that are listening can afford a home, well, they can. So prices are going to keep going up because they're still a buyer.
Huh. Okay.
So if you already own a home, great, good for you. If you can afford to buy one, go buy one now. That's going to be your store of value. And you've locked in a price, you've locked in a good rate, because rates are going to go up as well. If you haven't, you might want to do it now. But those asset prices are going to continue to go up. If you're younger, let's say that you're 20 to 35, and you haven't bought a home yet, well, you're probably going to be renting for a long time.